Welcome to the Cautious Trader. So today I have a presentation here for you courtesy of Financial Flagship. This account on TradingView, I recommend going to it and following it. It has brought us a beautiful presentation on the trend and some of the fundamentals of technical analysis. So let's go through it, let's see what it says, and hopefully it will be a good way for you guys to get started if you don't have some ideas about how the trend works, etc. etc. So it says technical research is founded on one main assumption: market prices move in trends as they are freely traded. Traders and investors hope to buy a security at a low price at the outset of an upward trend, ride the trend, and then sell the security at a better price when the trend stops. While this technique is straightforward, putting it into effect is incredibly difficult. And why is that? Because oftentimes people fear buying it at the bottom when it has bottomed or selling it at the top in fear of missing out on more gains. But let's get more into it. It says trends come in all shapes and sizes, from long-term patterns that last decades to short-term patterns that emerge minute by minute. All trends tend to have the same characteristics. Investors must choose which trend is most important for them based on the investment objectives, personal preferences, and the time they're ready to spend watching the market prices. A lot of the traders are day traders, meaning what? Meaning they open a position in the beginning of the day and they close it regardless of what happens by the end of the day. And this discipline allows them to operate on shorter time frames, such as the 4-hour candlesticks or the hourly candlesticks, or even sometimes the minute candlesticks, the 15-minute, the 5-minute, etc. So why is it important that we figure out which time frame we're using? Because the trends differ from time frame to time frame, and this is important. A lot of the times people that start trying to trade, they buy into a trend that they notice on the 1 hour time frame, but then they end up holding the position because the trend wasn't their friend, and then they say, oh well, I'll do a long-term position, or I'll buy and hold it. But then that's contrary to their investment objective and their investment philosophy that they started the trade with. So this is why it's important to have the discipline to choose your time frame and go with it as you wish. It says the trends are obvious in hindsight, but ideally we would like to spot a new trend right as it's beginning. Buy, spot its end, and sell. However, this idea is almost never the case, except by luck. So what exactly is a trend? An uptrend or upward trend occurs when prices reach higher highs and higher lows. A downward trend or downward trend or a downtrend or downward trend is the opposite, when prices reach lower lows and lower highs. A sideways or flat trend occurs when prices trade in a range without significant upward or downward momentum. And let's have a look here. Let's see what it's talking about. So upward trend, you see higher highs. So this is a high, and then the next high is higher than the previous high, and so on and so forth. Same with the lows. This is a low, so the next low is higher than the previous low, and so on and so forth. And then the opposite happens in a downtrend, and then in a range or a sideways trend, it goes and bounces within a prescribed range. Now, a lot of the times people wonder, is it easier while you're trading? Okay, is it easier to make money in an uptrend or in a downtrend? And this is something that a good YouTuber that I've watched for a long time, his account is called Four Flies. I highly recommend subscribing to him. He does a lot of Bitcoin analysis. He mentioned that oftentimes people buy into uptrends thinking that the uptrend is better way to make money. But in fact, money is made in downtrends, because in downtrends, you have previous price history. So you know where these resistant points are, and you can buy into them and ride the bounce and sell it, and then do this again and do this again. But if you're going in a higher high, higher low situation, and it's a market that has just broken out of its previous highs, well, you don't really know where the trend might stop, where the trend might reverse. And that's, of course, a little bit more tricky. You have to look at other indicators, and it just gets more complicated. So, from the investor trader's perspective, a trend is a directional movement of prices that remain in effect long enough to be identified and still be profitable. The most popular method amongst traders is to identify a trend by looking at a graph of prices for extreme points, tops and bottoms, and to draw lines between these extreme points. These lines are called trend lines. By drawing the lines between tops and bottoms, we get a feeling, quote unquote, of the direction of price movement, the rate of change of the movement, and also its limits. When those limits are broken, they can warn us that a trend might be changing. Another method for the study of trends are the moving averages, which smooth out and reduce the effect of smaller trends within longer trends and longer timelines, of course. The number of trend lengths is unlimited. The ability of trends to act similarly over different periods is called fractal nature. Is called fractal nature. When we say that the trends are fractal in nature, we mean that in any period we look at, these trends seem to reoccur. The similar characteristics and patterns are reoccurring. The trend length of interest is determined solely by traders' period of interest. This doesn't mean that different trend lengths should be ignored, because shorter trends make up longer trends. Any analysis of a period must include analysis of longer and shorter trends around. Lastly, trends are determined by supply and demand. As in all markets, whether Apple's oil or used car components, the economic principles of interaction between supply and demand determine prices in trading markets. That's, of course, assuming if markets are 100% efficient. And, of course, they're not. And a lot of the times, manipulation happens. Nevertheless, each buyer bids for a certain quantity at a certain price, and each seller asks for a certain quantity at a certain price. When the buyer and the seller agree and transact, they establish a price for that instant in time. Whatever the reason might be for the buyer wanting to buy and the seller wanting to sell, that price has now been established. The technical analysts, therefore, watch the price movement and the rate of change of prices, and this doesn't seem to concern them with the reasons for these transactions, because most times they are indeterminable. So when you see the value of Bitcoin skyrocketing to 60,000 US dollars, that's not necessarily because something major is happening in the world, or it could very well be because the value of the dollar is being diminished in the public perception, so they're flocking to Bitcoin. But regardless, this supply and demand creates a price action, and if we take the price action at its face value, then we can spot trends more easily. We can exploit these trends more easily. So the number of players and the number of different reasons for their participation in supply and demand is close to infinite, and that's why we shouldn't be looking at them. Thus, for technical analysts, it is futile to analyze components of supply and demand except through the prices they create. Furthermore, when someone invests or trades, the price is what determines profit or loss, not corporate earnings or federal revenue reserve policy. The bottom line is that price is what determines success. Fortunately, or for whatever reason, price tend to trend. And he says trade with care, and if you like the content, of course support the page. Again, this was from Financial Flagship and I recommend this. Let's look at this again. So this is the British pound versus the USR. Let me just zoom out. I'm sorry. That's trading view always is tricky to zoom into. So as you can see, the upper trend is characterized by these higher highs, lower lows, right? But within each one of these, you see there are downtrends, right? So if you were trading this, this is the daily chart. If you were trading this in an hourly situation, then you would be looking at a different scenario, of course. And then in a downtrend, you see massive lower lows and lower highs. But again, look here, within a different time frame, we could be looking at an uptrend, right? And that's because different supply and demand statistics, or if you will, philosophies apply to different hour or day time frames. Now, if you utilize a moving average such as this, it smooths out the price action, and this allows you to notice this upward trend more easily, and also allows you to look at where the price might be bouncing, right? If it starts retracing, well, it could bounce from the moving average. And if it breaks it, then that's an indication of what? That's an indication for a trend reversal. So when here it was going down, 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 and this is oddly similar to the chart of Bitcoin from I would say 17, December of 2017 to around 2018, June of 2018, something like that, when price of Bitcoin broke the $6,000 floor. But this is of course gold, so disregard what I said. And when it breaks that level, it starts a new trend. And this trend for gold, at least, it was down, and then it went into a sideways range before bottoming out, creating an uptrend within a smaller time frame, and then continuing lower. And this, of course, is where it's at right now. So, yeah, I like to show you price chart for Bitcoin before I leave you with this. And show you how I tend to draw these trend lines so you can have a look. Let's resize this chart. For example, on the hourly chart, what we may notice is that right now we were in an upward trend, but now we've broken downwards, and now we are coming up to test this moving average. And if this moving average causes Bitcoin to retrace and roll over, then we would see Bitcoin prices fall into a downward trend and move lower and lower till they hit this resistance at $51,000. But let's look at a different timeline. For instance, in the daily chart, you see that we are still in this upward trend, and just now we're trying to test this EMA ribbon, these ribbons that you see here, and if they bounce off of these ribbons, then we could see Bitcoin making a go for higher highs, such as 70 or 75,000. But if it breaks this EMA ribbon, and usually the narrower the EMA ribbon gets, the more likely it is for the price action to break below it. It could break below and come all the way to test the $35,000 range and the moving average. And the moving average is essentially, again, what will give it another bounce. Because the moving average right now is in an uptrend, we could see Bitcoin coming back to test. All right, with that said, this has been the Cautious Trader. If you have questions, comments, or concerns, leave them in the comment section below. If you found this video of any value, please leave a like and of course share it with friends that you think might find it interesting. And as always, I would recommend subscribing and enjoying the rest of your day. Have a lovely time and bye for now.